Well, folks, we're most likely getting a new Federal Reserve chairman, and I know this just rocks your world this morning, so, or whatever time of the day you're listening to this. Um, but Trump has nominated Kevin Walsh to replace Jerome Powell. Okay, and I wanted to give you kind of a quick hot take. I'm not going to get all super political about this, but more just what does this mean or potentially mean? I mean, he's got to be approved first by Congress, but what does this mean for the picture of real estate in 2026? Where are we heading in the real estate landscape for our buyers, especially, and our sellers? So, uh, well, first of all, Kevin Walsh appears to be kind of a financial inside player here. He was on the Federal Reserve Board of Governors from 2006 to 2011. I'm reading from the Wall Street Journal, playing crucial behind the scenes roles in Washington's rescue of Wall Street during the financial crisis. Um, uh, Trump's selection of Walsh would bring an end to a months-long internal deliberation among the president and his top advisors who should lead the central bank. Um, what Trump wants to do is lower interest rates further. He's said this a number of times. The federal funds rate is at like 3 point something right now, 3.7 or something like that. And Trump wants to, he said that it should be 1%, something in that range. So I think this is a political pick, of course, without trying to wade into politics too much. And I think what Trump is trying to do is get somebody in there who will lower rates further. Okay, so what does that mean if you're thinking about buying a house in 2026 or maybe 2027? Well, rates seem to be on their way down, and this is a further indication that we're going to see that trajectory continue. Um, uh, is it good for rates to be lower? Well, the devil's in the details here. Let me explain what this looks like from our point of view working in real estate every day. I would love for rates to be lower. I would love for mortgages to be more affordable and more people to be able to get into houses, especially entry level houses, where it can be really tough for some of our first time home buyers. The houses have gone up a lot in value and pricing, and then interest rates are higher than they used to be. So it can be tough to be able to afford that payment. But the other thing we have to think about is inflation. And so I really hope that the Fed, if he gets nominated, and I mean, if he gets approved and implements policy, I hope that the Fed continues to be or stays, just boring and steady. And I hope that there's nothing too radical that they do. And I hope that they don't push the rates lower, allow the rates to go lower than they should be. Because if inflation starts to be a problem and the economy starts to grow too hot, then it's going to negate, for our customers who are trying to buy houses, it's going to negate the advantage of the lower mortgage payment when the cost of everything is going up. I went to the bakery the other day and I bought a sourdough boule and it was $8. Okay, it's $8 for a loaf of bread. So, just when the cost of everything is going higher, that's eating away at your overall cost of living, and it's effectively reducing how much of a mortgage, how much of a house you can afford. And if we make a trade-off where we get lower and lower rates again, and the consequence of that is that it's moving us the wrong direction on inflation, it's not going to be worth it. And then the other thing we have to remember is we went through 2020, 2021. I worked, like crazy through that whole period. And those ultra low rates, and I'm not saying I think we're going to end up back there with 2.875 and 3% mortgages and whatever. But that didn't do buyers any favor, even though it was nice to get that low mortgage and it helped some people for sure. It also meant we had these crazy bidding wars, way too much competition, too few listings, too many buyers. I hate to say that there were too many buyers. It sounds crazy, like too many customers, but no, there was just too little inventory and too much competition in the market, and it made it really, really hard to buy a house. It made it expensive to buy a house because you had to, in many cases, offer way more than the asking price of the house by tens of thousands of dollars in order to get the deal done. So there were trade-offs, absolutely. And there's this one little thing in this Wall Street Journal article I wanted to highlight too, that maybe I could just leave you with. This transition, and again, he's got to be approved, so we'll see what happens. But this transition could mark the most significant changing of the guard at the Fed since 1979, when Paul Volcker took over and dramatically reoriented the institution's approach to inflation. The stakes are high for Trump and extend beyond politics. The Fed sets short-term interest rates, but long-term rates, which determine mortgage costs, car loans, and the government's interest expense, are also shaped by investors' expectations about inflation. An independent Fed has historically meant lower long-term borrowing costs because investors trust the central bank to keep inflation in check. A Fed seen as bending to political pressure could push those costs higher. So, what does it mean, again, if you're thinking about buying a house in 2026? Well, don't wait for more news because we don't know what's going to happen. But it looks like interest rates maybe steadily on their way down, probably nothing huge, but moving that direction at least. And we just hope that all this continues to be good economic policy for mortgages and a good space for buyers and sellers. Okay, I hope this little analysis helps. Thank you for watching.